at the red line, and I now want to look at the red line in terms of trending directions, let me just get rid of all the drawings. If I now look at the red line in terms of trending directions, would you agree that the red line is a very good trending indicator for bonds? Well, you can see that obviously with a big flip around here, which simply went into a parallel shift, but generally as a rule, I want to trade in the direction of the red line. I want to trade in the direction of the red line in terms of bonds. And on a macro scale basis, you can see that this is one of the strongest signals we had to be selling this 144 up here. We annihilated the 144 short sell up here because we want to be trading that bond. Now, if I know that the red line is going to turn, which is obviously the whole idea of looking at it from the green and the blue line perspective, not the red line in isolation, but if I now look at this in terms of the blue line and the green line, and I look at the red line, so what I'm looking for is I'm looking for that red line to appear, for example, at a bottom edge. Now, a lot of the times when you look at the red line and the green line together in the close nature of it, it's very difficult to spot the red line standing out there, Scott. Who asked the question? Was it Scott or was it Steve? I think it was Steve. Okay, so when it's very difficult to recognize, for example, the red line standing out here, but you can see that the red line is standing out here because you can see that the blue line is breaking significantly higher here. So that helps us identify, it's not really anything to do with the blue line, it just helps us identify that the red line is standing out at the bottom edge. Now what happens, of course, is that the blue line starts to edge back inside again here, which as a negative correlation should now send the red line higher. Well, if we start out by knowing and understanding the idea that if the red line is going to go higher, we'd expect bonds to start going higher, that's a really nice trigger, to start looking at the possibility of bidding a low price of bonds during this period here. There's a possibility of bidding a low price bond. So when we look at bonds during that period, you can see that there was a little bottom edge just at that stage, a little bottom edge just in there at 15s, and it rallied up to a high price of 27s for $350. So there is a directionality to it, because we have to first of all recognize what the directionality component is. We can see obviously here, this is a very, very clear example here. So if we get rid of the idea of the red line for a second here, we can start to recognize what is happening elsewhere with the blue line and the green line. So it doesn't matter which way we decide to dice this. If we start seeing this type of situation here, and we start seeing this type of situation here, you're starting to look at that saying, okay, well, that must mean that the red line is very, very, very low. So anytime that starts turning back in, I would know that I should be able to bid for bottom edge bonds. I should be able to buy bottom edge bonds. And you can see that when that starts deciding to turn back down again here, you can start to see that turn there. You can see where the buys are quite clearly highlighted because we've got that skew in place. So we can sense that there is a turn coming. The only downside for us was that on this occasion, the blue line hadn't turned. It's always good when the blue line turns. However, if the red line's turned, and the red line did turn back up, suggesting that the blue line is going to drop back down again, they should go in equal and opposite directions. That's the point. Because they're skewed so widely, they should go in equal and opposite directions. So when one turns, it gives us a chance, because obviously they're skewed in different ways. One skewed to the front end and one skewed to the back end. So we don't know which one's going to go first. That's the point of the skew. We don't know which one's going to go first, the front end or the back end. But what we do want to know is that if one of them goes, the other should follow. So when the red line starts to turn back up again here, I'm now thinking that that blue line is massively exposed, because the blue line hasn't turned down yet. And realistically, there's an incredible high probability that that is now going to start selling off those high prices, which means there is an equally incredible opportunity that bonds at low prices will start bidding off the low price. And we get this massive rapid rally, which turned out to be a parallel shift in the markets. We got a parallel shift through here, which took us from 141.20s to 143.12s, nearly $2,000 of upside profit on bonds this afternoon. But it's about just recognizing the relationship of these elements It's not about the arithmetic behind it. It's about that idea that one does one thing and the other does the other. It's this idea that one is related to front end and one is related to back end, and when they push, they should pull. If one pushes, the other should pull. So when this starts to push up, this should push down. We should see that. And if it doesn't push down, we start recognizing it will eventually push down. Preferably if the two of them are pushing and pulling, you're getting a perfect correlation. Everything is going, the front end is right, the back end is right, but that doesn't happen very often, as Reeve rightly pointed out before. The back end and the front end don't always go in perfect harmony with each other. So what we've got to try and do is we've got to try and recognize when one is moving, there's a high probability that the other, and that's confirmed by the green line helping us out a little bit here. So for example, here's a possible example here. You can see that the green line is diverging into the low price here. The red line isn't. So the red line actually made a new lower low there. But you can see that the blue line has started to drop down in line with the green line. Well, what does that tell us? That tells us that red line should be going higher. It tells us that the red line should be going higher. In other words, the back end of the curve should be moving up. So obviously, whilst the back end of the curve isn't moving up, it still presents us with a nice opportunity to bid the back end of the curve, which would be, in this case, the ultra bond market. Because obviously we're now expecting, with the blue line falling and being the fact that it's a negative correlation, the red line should now rally. And obviously that rallying of the red line should bring the back end of the curve into profit to the upside, which is exactly what's happened. So this is something we can see. We can actually recognize this. It's very much like the current top edges up here as it's developing here. You can see that the red line is making a significant higher high. So that's a challenge for us. But you can see that the green line at this stage is not making a significant higher high. And you can see that the blue line is actually starting to turn back up again, which means that there is a sell at 12. So we could grab a little short trade at 12, and you've seen it's just actually dropped since we've been talking about it back down to 9s. This is a 1 minute chart, guys. So it's just dropped from 12 since I started talking about it. And it's dropped back down to 9s, allowing you a 3-tick stop at break even. And you can see that it's about recognizing that one should cause the other. Now, sometimes that doesn't mean we've got a trade. We still have to have an edge on the trade. So, for example, we can see that the blue line's starting to fall here, but the bond's already higher. So that doesn't give me a trade. That doesn't give me anything at all at that stage, right? So we don't get a trade at that stage there. We don't get anything at all in here because there's now a strong divergence here in terms of selling bonds at higher prices because of what's happening to the red line. So we don't want to make sure we add that into our picture as well. There has got to be a directionality to this that makes a lot of sense. So we've got to be careful with the directionality. You can see that the red line has pushed higher, so is the green, so I'm not going to resell this. We've made 3 ticks on that sell trade. It stops at break even. In worst case scenario, you've scratched out at +1 or you've scratched out at 0, and you're waiting for a new piece of information. Because the green line's pushing, well, that's not enough confirmation to sell at higher prices, so you just start looking for that to start diverging at higher prices for another resell. Probably realistically somewhere around about the 16 print. But again, it's just about recognizing what it is and the directionality attached to it. If the blue line starts rising, that should pull the red line. If the green line's rising, that'll keep the red line moving. And it will be likely that the blue line will start just holding. So it's about just that subtle difference between the two. But we'll certainly come back to cover this in more detail tomorrow when we've got the time to do it. We'll be starting in today's classroom, guys, in just 60 seconds.